Your 20s, this is your golden ticket. It is your superpower for building serious, long-lasting wealth. Why, you ask? Because you have the most precious asset of all on your side, and that asset is time. Time allows the magic of compounding to work wonders for your money. Every single rupee you invest today has the potential to grow manifold over the decades. Do not waste this incredible advantage. Start now. Start today. Your future depends on it. The financial freedom you dream of, owning your own home, traveling the world, not worrying about bills. It is not just a dream, it is a plan, and the foundations of that plan are laid in your 20s. The small, consistent steps you take with your money in this decade will determine the giant leaps you can make later in life. Think of it as planting a small sapling. With care and time, it grows into a mighty tree, providing shade and fruit for years to come. Your investments are those saplings. Stocks or real estate? Which path should you choose to build this wealth? Both investment avenues have their champions and their critics. Making informed decisions, not emotional ones, is absolutely key to your success. Get ready to take control. So, what exactly are stocks? Let me make it very clear. When you buy a stock or a share, you are buying a tiny piece of ownership in a company. Imagine owning a slice of big Indian companies like Tata Consultancy Services, or HDFC Bank, or even global giants like Apple or Google. When these companies perform well, when they make profits and grow, the value of your ownership piece, your share, can also grow. It is as straightforward as that. You are betting on the success of businesses. Investing in stocks is remarkably accessible today, especially for you young folks. To start, you need a demat account, which holds your shares electronically, and a trading account, which allows you to buy and sell them. Most major banks in India offer these services, often as a 3-in-1 account including your savings account. Furthermore, numerous online discount brokers have made the process even simpler and cheaper. You do not need a fortune to begin. You can start investing with just a few thousand rupees. The process of getting started is also very quick. Once your documents are verified and your account is active, you are ready to make your first investment. This is power. Let's shift gears and talk about real estate. What does investing in real estate mean? It typically means buying a physical property. This could be a flat in a high-rise building, an independent house, a plot of land, or even a commercial space like a shop. The primary goals are usually twofold, either for the property's value to appreciate over time so you can sell it for a profit, or to earn regular rental income from it. For many, real estate feels tangible. You can see it, touch it, and it feels solid. However, when it comes to accessibility, real estate presents a much higher entry barrier compared to stocks. The most significant hurdle is the down payment. In India, you typically need to pay at least 20% of the property's value up front from your own savings. This is not a small step. Let's talk about returns from stocks. The stock market can offer potentially high returns. If you look at historical data, equities as an asset class have often outperformed many other investment options, like fixed deposits or gold, over the long term. Think about the journey of benchmark indices like the Sensex or Nifty over the past 2 or 3 decades. The growth has been substantial for those who stayed invested. This potential for significant wealth creation is what draws many people to the stock market. However, you must understand this. With the prospect of high returns comes high risk. Stock markets are inherently volatile. This means prices can go up and down, sometimes very sharply and very quickly. One day the market is soaring, the next it could be tumbling. We have seen market crashes and corrections in the past, the dot-com bubble, the 2008 financial crisis, the COVID-19 panic. They happened, and they will happen again. You need to have the stomach for this volatility. You must not panic and sell your investments at the first sign of trouble. Here is where being young gives you a distinct advantage. Time, you have plenty of it. If the market takes a downturn, you have years, even decades for your investments to recover and grow. You can afford to ride out these temporary storms. Diversification is your best friend in managing stock market risk. Section 5. Real estate slow and steady wins the race. Now let's consider real estate returns and risks. Real estate is often perceived as a more stable and less volatile investment compared to the stock market. Property prices generally tend to appreciate more steadily over the long term. You typically don't see the wild day-to-day or month-to-month swings in property values that you witness in stock prices. This perceived stability can be very comforting for many investors. It feels more secure, more grounded. It is something you can physically see and touch. Historically, real estate in many parts of India has delivered good returns, especially in rapidly urbanizing cities and well-chosen locations. Land is a finite resource. The population continues to grow, and with it, the demand for housing and commercial spaces. This fundamental demand-supply dynamic often drives property values upwards. However, appreciation is not guaranteed, and it is certainly not uniform across all properties or locations. In real estate, the mantra is location, location, location. The right location can make all the difference between a profitable investment and a stagnant one. You must choose wisely. Section 6. Managing your money machines. Time is money. When you invest, you are essentially putting your money to work for you. But how much work do you personally have to do to manage these investments? Let's compare stocks and real estate from a time and maintenance perspective. Investing in stocks, particularly if you adopt a long-term buy and hold strategy or invest through mutual funds, can be relatively low maintenance. You don't necessarily need to be glued to your screen tracking stock prices every minute of the day. Once you have made your investment choices after proper research, you can largely let them be. In fact, you can automate your stock investments to a great extent. Systematic investment plans, or SIPs, in mutual funds are a fantastic tool for this. With an SIP, a predetermined amount of money is automatically debited from your bank account and invested in the mutual fund scheme of your choice every month. This not only instills a habit of disciplined investing, but also helps you benefit from rupee cost averaging. Real estate, on the other hand, typically demands a much more significant investment of your time and effort. If you decide to rent out your property, you essentially become a landlord. This role comes with responsibilities: finding reliable tenants, drafting lease agreements, ensuring timely rent collection, addressing tenant complaints, and handling repairs and maintenance issues. This can sometimes feel like a part-time or even a full-time job. Section 7. Power up your portfolio, leverage and income flow. Let's discuss a powerful concept in investing: leverage. Leverage simply means using borrowed money to make an investment. The idea is that if your investment earns a higher return than the cost of borrowing, the interest on the loan, you can significantly amplify your profits on your actual out-of-pocket capital. However, leverage is a double-edged sword. If the investment performs poorly, your losses can also be magnified. Real estate is an asset class where leverage is very commonly and effectively used. When you buy a property, you typically take a home loan from a bank or a housing finance company. You pay a portion of the property's price as a down payment, say 20%, and the lender finances the remaining 80%. This ability to control a large asset with a relatively small amount of your own money is what makes leverage so powerful in real estate. Can you use leverage in the stock market? Yes, you can. It is called buying on margin or margin trading. This involves borrowing money from your broker to buy more stocks than you could afford with your own cash. However, I must warn you, this is extremely risky, especially for inexperienced investors. Section 8. Tax smart, wealth smart, playing the long game. Taxes. Nobody likes paying them, but they are a fact of life, especially when your investments start making money. Taxes can significantly eat into your investment returns if you are not careful. Therefore, understanding the tax implications of your investments in stocks and real estate is absolutely crucial for wealth building. Smart tax planning can help you legally reduce your tax burden, leaving more money in your pocket to reinvest and grow further. For investments in stocks and equity mutual funds in India, the tax rules are quite specific. If you sell your stocks or equity fund units after holding them for more than 1 year, the profit is considered a long-term capital gain, LTCG. LTCG on equities up to 1 lakh rupees in a financial year is tax-free. Gains above this limit are taxed at a flat rate of 10%, without any indexation benefit. If you sell within 1 year, the profit is a short-term capital gain, STCG, taxed at 15%. Real estate also comes with its own set of tax benefits and liabilities. If you have taken a home loan to purchase a property, you can claim tax deductions on both the principal repayment and the interest paid. The ultimate aim is to maximize your net, after-tax income and wealth. Section 9. The winning formula: stocks and real estate together. So, after all this discussion, what is the verdict? Stocks or real estate? Which one is the ultimate wealth-building champion for you in your 20s? The truth is, the answer is not an either-or choice. For most young adults who are serious about building substantial diversified wealth for the long term, the most effective strategy often involves a combination of both. A well-balanced portfolio that includes both equities and property can help you manage risk better and capture rewards from different market dynamics. In your early 20s, when your income might be just starting to grow, and you may not have a large corpus for a property down payment, focusing more on stocks often makes sense. You can begin investing in stocks or equity mutual funds with small, regular amounts through SIPs. You have a long investment horizon, which allows you to ride out the inherent volatility of the stock market and benefit from the power of compounding. The goal here should be aggressive growth. Build a solid foundation in equities first. Then, as your income increases and your savings accumulate, perhaps in your late 20s or early 30s, you can start seriously considering investing in real estate. By this time, you might have saved enough for a down payment and have the financial stability to manage a home loan. The winning formula, therefore, lies in balance and strategic allocation. Use the liquidity and high growth potential of stocks to build your initial wealth rapidly. Later, incorporate real estate for its stability, income generation, and the benefits of leverage.